Yo, what's up everyone? Welcome to episode 4 of trading walkthrough to profitability. It's been about 2 weeks since I made a video. It's been a while, but you know, we can't give up. We gotta keep persisting. We're not, this is not a temporary thing. I'm actually gonna finish all the videos. So here's what we're talking about today: bulls and bears, buyers and sellers, fair value gaps, inverse fair value gaps, and news. So first, bulls and bears. A bullish move refers to a move up, and a bearish move refers to a move down. So what does this mean? When we are bullish, we are moving up. When we're bearish, we are moving down. So that's just some terminology. So when an uptrend, if you've seen the older videos, an uptrend is when we're in bullish order flow. So when the market's trending up, so that would be bullish trend. Bearish is the opposite, so if we're trending down. So like we can see on this chart here, this is a bearish trend. This is a bullish trend. And all it means, the bulls are the buyers and the bears are the sellers. So easy, whatever you want to use to remember it, just keep that in your mind. People will say, oh yeah, we're in a bearish trend right now, that just means we're going down. Bullish means we're going up. The next thing we're going over, fair value gaps. Now this is a really important one for my strategy personally. Something I use in every single one of my trades. If I don't see a fair value gap, I do not take the trade. So this is one of the biggest confluences you're going to learn in this series of videos. So a fair value gap is a series of 3 candles. So they can be any size, any color. The specific thing that makes them stand out and become our confluence is the gap. So let me explain. Let me change the color of these. So imagine we're in an uptrend and you see a 3 candle pattern just like this. The first candle, the second candle, a big large second candle, and third candle. Now what you'll notice about these 3 candles is between the first wick, the top of the first wick and the bottom of the third wick, there is a gap inside the body of the second candle. This is the fair value gap. What does this mean? This means that if we see price move back into this gap, so imagine we go like this and we retrace back into this gap, what is likely to happen is one of 2 things. The first thing we're going to go over is if the gap gets respected. So if a gap gets respected, we see it tap back into the fair value gap and continue moving in the direction it was going originally. So we've seen it go up, retrace back into the gap, and then continue upwards. So imagine a fair value gap is like a magnet. It magnetizes price to it to either respect it or disrespect it. So disrespecting a fair value gap, what that would look like is candle closure below the gap, like that. So if we had a fair value gap and a black candle close below the gap, this is now an inverse fair value gap. So this is disrespected. So what this tells us is that we are likely to do the opposite. We're not likely to tap back in and continue going. We're likely to tap in and reject it and continue going in the direction this candle's closed. So refusing the direction of the fair value gap. Another version of a fair value gap is the opposite, a bearish fair value gap. So I'll just make one quickly. Now this is a bearish example of a fair value gap. Now if you notice, I've done 2 of the candles in black and 1 of the candles in blue. This proves that no matter what color the candles are, as long as the first and the third candles wicks are not overlapping in the body of the second one, this is a fair value gap. So let me mark that out so you can see what it looks like. the center and the gap in the body of the second one between the first and the third wick, this is our fair value gap. What are we likely to do? We can either respect the gap from here, tap in and continue, or we can get a candle closure below it, which will tell us, you know, we've rejected this fair value gap and we're going to continue this way. We're going to continue going up in this case. Now, if we can mark out some examples on the chart. Now, it's obviously a lot harder to mark out examples on the chart. There's a lot more things going on. There's a lot of confusion looking at a chart. But if you look at like the longer candles, you'll be able to find it easier. So, for example, here, if you look, if we look at these three candles, we've got the first candle and the top wick, the second candle, a large body, and the third candle, the wick is not overlapping the first wick, the wick of the first candle. So this is our gap. If we see price draw back into the gap, then we would be waiting for either a candle closure below it, which would confirm an inverse fair value gap, or we would be looking for it to tap in, not close below the gap, and continue up. That's all it is. That's all we're looking at for a fair value gap. Let me find a bearish example. That was a bullish example. We're going to look for a bearish example. Like I said, it can be any combination of candles. Like this here, we've got a blue, a black, and a black. We still have a fair value gap here between the first candle wick and the third candle wick. This is our gap. If we saw it draw back into this and continue down, that's our signal. We should be taking trades downwards. If we saw it move into the gap and close above it, what does that tell us? It tells us, boom, we're going to continue moving up. Here, we didn't see it draw back in at all, so we wouldn't have used this gap, but it's useful to know because there is so many situations where drawing into a fair value gap has huge moves. Here we go, perfect example. A bullish fair value gap. This candle, this candle, this candle. Gap between the first and the third wicks. Closure here, candle closure, below it. What do we do after that? Boom, huge downtrend. Huge downtrend. Just off one fair value gap. Now, another thing, if we start to use our confluences together, if you could see, this is liquidity. We sweep liquidity, have an inverse fair value gap, and we have a huge move down. You know, if you took this move purely based off this candle closure, stops above the fair value gap, you know, you could have targeted a huge move here. So you could have targeted a 3.7 risk to reward on that trade, and it would have hit, which is the main part of my strategy at the end of the day. It's all the liquidity, breaker structure, invest fair value gaps, all of that in conjunction with together. Huge potential, as I've just shown. And now the final thing, we're going to be off the charts for this one. News, Forex Factory, and red folders. What am I talking about here? What is news? What is a red folder? What am I talking about? So finance news that largely moves the market. How do we know how to check this? Well, we know it's going to move the market, but when does it happen? Like, where do we check this to? So what I need you to do, you're going to open Safari, Google, whatever you want to use. Any browser. Open your browser. You're going to type in Forex Factory. Boom. You're going to get to this page. It's so confusing. You're like, what am I looking at? Ignore everything. Ignore everything. Apart from this bit right here. This little table that says today's date and what's going on today. Simple as that. So as you can see, so many yellow, red, orange folders. What are these? Majority of this is going to have little to no impact. The yellow folders, small news. Orange folders, relatively large news. And the red folders are the large news. So the red folders are the one you want to look out for. If you press the filter button in the corner, turn all of them off except for the red ones. And then you have your currencies on the right hand side. So if you trade, let's say GBP, you want to keep on the GBP. If you trade USD like I do, you want to keep on USD. And apply the filter, and you're going to see only one red folder. So probably not too big of a news event. So we wouldn't really worry about that. But there are some very large news events, and if there is news, what does this mean? Here we go. We've got 3 very big red folders on this day. What does this mean? It means do not trade. If you have multiple red folders on your day, make sure you check it at the time you're going to be trading. Do not trade for that day, because all you're going to get is you're going to get these huge candles that are going to stop you out. You're going to lose a bunch of money. It's going to be over risking, over leveraging. It's not worth it. If you see multiple red folders, just don't trade. So yeah guys, that's today's episode. Your homework for today, I want you to mark out 5 fair value gaps, 5 inverse fair value gaps, and go onto Forex Factory and look at the news, filter it to the thing you want to trade, understand what a bull and a bear is, and bullish and bearish order flow, understand that. Rewatch the video, take notes if you have to. Just mainly find your fair value gaps and find your inverse fair value gaps. Mark them out on your chart, and then go in your browser, look at the news for the next month, whatever. Look for your red folders, just mark them all out.